Chapter 8: Saving, Investment, and the Financial System. The financial system is a group of institutions in the economy that help to match one person's savings with another person's investment. When countries save a large portion of its GDP, more resources are available for investment in capital, and higher capital raises a country's productivity and living standard. The financial system is made up of financial institutions that help coordinate the actions of savers and borrowers. Financial institutions can be grouped into two categories: financial markets and financial intermediaries. Financial markets are institutions through which savers can directly provide funds to borrowers. The bond market uses bonds, or a certificate of indebtedness. A bond is a certificate of indebtedness that specifies the obligations of the borrower to the buyer of the bond. The buyer of the bond gives his money to the company in exchange for this promise of interest and eventual repayment. The first characteristic is a bond's term, the length of time until the bond matures. To compensate for a risk of long-term bonds usually pay higher interest rates. Long-term bonds usually pay higher interest rates than short-term bonds. The second important characteristic of a bond is its credit risk, the probability that the borrower will fail to pay some of the interest or principal. Such a failure is called default. The third important characteristic of a bond is its tax treatment, the way tax laws treat the interest earned on the bond. The fourth important characteristic is whether it offers inflation protection. Most bonds are written in nominal terms. The stock market. A stock is a share that represents ownership in a firm and is therefore a claim to some of the profits of that firm's earnings. The sale of stock to raise money is called equity finance, whereas the sale of bonds is called debt finance. The owner of shares of stocks of the stock is part of the owner. The owner of the shares of stock is part owner of the company that sold the shares, while the owner of the company that sells bonds is a creditor of the corporation. Financial intermediaries are institutions through which savers can indirectly provide funds to borrowers. For instance, banks. Banks are financial intermediaries with which people are most familiar. A primary job of the bank is to take deposits from people who want to save and use these deposits to make loans to people who want to borrow. The bank pays depositors interest on their deposits and charges borrowers slightly higher interest on their loans. The difference between these rates of interest covers the bank's costs and returns some profit to the owners of the bank. To facilitate purchases of goods and services, banks allow people to write checks against their deposits and to access their deposits with debit cards. In other words, banks help create a special asset that people can use as a medium of exchange. Mutual funds is an institution that sells shares to the public and uses the proceeds to buy a portfolio of stocks and bonds. The primary advantage of mutual funds is that they allow people with small amounts of money to diversify their holdings. Because the value of a single stock is tied to fortunes of one company, holding a single stock or bond is very risky. By contrast, people who hold a diverse portfolio of stocks and bonds face less risk because they only have a small stake in each company. Mutual funds make this diversification easy. A second advantage claimed by mutual funds companies is that mutual funds give ordinary people access to skills of professional money managers. All these financial institutions serve the same goal: directing resources of savers into the hands of borrowers. Saving and investment in the national income accounts. National savings is the total income in the economy that remains after paying for consumption and government purchases. For the economy as a whole, savings must equal investment. Private savings is the income households have left after paying for taxes and consumption. Public savings is the tax revenue that government has left after paying for its expenses. A budget surplus is the tax revenue over government spending. Is budget surplus is an excess of tax revenue over government spending. Government deficit or budget deficit is a shortfall of tax revenue from government spending. To explain how financial markets coordinate an economy's savings and investment, and to analyze how various government policies influence savings and investment, we build a model called Market of Loanable Funds. The market of loanable funds is a market in which those who want to save supply funds and those who want to borrow to invest demand funds. In this model, savings is the source of the supply of loanable loans, and investment is the source of the demand of loanable funds. The interest rate is the price of a loan. It represents the amount the borrower pay for loans and the amount the lenders receive on their savings. Because a high interest rate makes borrowing more expensive, the quantity of loanable funds demanded falls as the interest rate rises. The adjustment in interest rate to the equilibrium level occurs as usual for the usual reasons. If the interest rates were lower than the equilibrium level, the quantity of loanable funds supplied would be less than the quantity of loanable funds demanded, resulting in a shortage. Conversely, if the interest rates were higher than the equilibrium level, the quantity of loanable funds supplied would exceed the quantity of loanable funds demanded. As lenders compete for scarce borrowers, interest rates would be driven down. Therefore, the supply and demand for loanable funds depend on the real interest rate. The equilibrium should be interpreted as determining the real interest rate in the economy. This model of supply and demand of loanable funds shows that financial markets work much like other markets in the economy. For instance, in the market for milk, the price of milk adjusts so that the quantity of milk supplied balances the quantity of milk demanded. The market for loanable funds. The interest rate in the economy adjusts to balance the supply and demand for loanable funds. The supply of loanable funds comes from national savings, including private savings and public savings. The demand for loanable funds comes from firms and households who want to buy for purposes of investment. One of the 10 principles of economics in Chapter 1 is that a country's standard of living depends on its ability to produce goods and services. Another principle is that people respond to incentives. Let's look at a negative incentive of taxing revenue, including interest and dividend incomes. To see the effects of this policy, a 20-year-old who saves $1,000 and buys a 30-year bond that pays interest at 9%. In the absence of taxes, the $1,000 grows to $13,268 when the individual reaches age 55. But if interest income is taxed at a rate of 33%, the after-tax interest is only 6%. In this case, the $1,000 grows only to $5,773 over 30 years. The tax on interest income substantially reduces the future payoff of the current savings, and as a result reduces the incentive for people to save. Tax reform laws can encourage greater savings. That result would be lower interest rates and greater investments. Saving incentives that increase the supply of loanable funds, such as a change in tax laws to encourage Americans to save more, would shift the supply of loanable funds to the right. As a result, the equilibrium interest rate would fall, and lower interest rate would stimulate investments. See Figure 2. In Figure 3, investment incentive increase the demand for loanable funds. If the passage of an investment tax credit encouraged firms to invest more, the demand for loanable funds would increase. As a result, the equilibrium interest rate would rise, and the higher interest rate would stimulate savings. See Figure 3. What's the effect of government budget deficits? When the government spends more than it receives in tax revenue, the resulting budget deficit lowers national savings. The supply of loanable funds decreases, and the equilibrium interest rate rises. Thus, the government borrows to finance its deficit. It crowds out households and firms that otherwise would borrow to finance investments. The equilibrium interest rate rises, and the equilibrium quantity of loanable funds saved and investment falls. The fall in investment due to government borrowing is represented by the movement along the demand curve and is called crowding out. Throughout history, the primary cause of fluctuations in government debt has been war. When war is over, government spending declines and the debt to GDP ratio starts declining as well.